There we are. Okay, right on. Well, welcome everybody to the 2025 State of the Markets. Before I pull up our slides and kick us off here, I'll make some brief introductions. For those who don't know me, Sam Boyd, CFP, founder and president of Confido Advice and Investments. I am joined today by two esteemed colleagues. We've got Tom Galgano from Vanguard with us. He's been at Vanguard for over 14 years, CFA charter holder, chartered alternative investment analyst, and also received his bachelor's from Villanova's Barley Business School. So thank you, Tom, and welcome. Appreciate your support.
Thanks for having me, Sam.
You got it. We also have Brad Pineault with us as well. He's been with Fidelity for 26 years, also a CFA charter holder, certified investment management analyst. He received his bachelor's from University of Massachusetts Dartmouth and his master's from Bryant University. So thank you for joining us, Brad.
You bet, Sam. Great to see you.
Okay, so with that, let me share my screen and we will get rolling here. Righty. There we go. So, state of the markets, and obviously there's been a lot going on in the markets the past couple of weeks, so it's a good time to be getting together. I got to jump through our disclosures here briefly to keep compliance happy, and then we'll kick off with where we've been. So, the last 2 years were, wonderful, especially in the U.S. markets. Large cap stocks, turned in, back to back 20+% returns. I think everybody looks at that and says, how sustainable is this? Can that continue? Well, there's not a great sort of population of data points to look at, in this case. There's really 3 decades we can look back to the sort of, 1930s following the Great Recession, 1950s following World War II, and then the lead up to the dot-com bubble. And the results in the following years, are really unpredictable. So there's not a great, sort of corollary in history that we can look at to say whether, it is, sustainable or otherwise. But it doesn't mean that the markets need to fall. Now, where are we today, right? So if we look at the S&P 500 and we look at the PE ratio or the price earnings ratio, which is for those who aren't familiar with it, that's a tool we use to say whether stocks are cheap or expensive. How many multiples of earnings are you paying for the price of a stock? So historically, PE ratios have averaged over the past 30 years around 17. On January 31st, S&P was at 21.9. So if you look at these other broad sort of metrics of valuation, the S&P, with the exception of earning yield spread, is not cheap, right? It's more expensive than the sort of historical average, but the market gets expensive, at times. What does PE ratio tell us? Well, not much in, a given year, right? The correlation between what your PE ratio is and what your returns are 1 year out really doesn't add up to much. But over longer periods of time, that correlation does tighten up a bit. And so, price matters, and we want to be aware of valuations, sort of at all times. And so, Tom, I wanted to see if you could talk a little bit about this slide here that sort of explains the quote unquote equities being overvalued and what's contributed to that over the past 10 years.
Yeah, of course. And hello to everybody out there. Tom Galgano from Vanguard, like Sam said. We as a firm have really taken strides over the last, call it 5 years, to build out our forecasting and our economic capabilities. But by and large, the real theme here is that nobody really knows what's going to happen. And at the end of the day, the things that win are diversification, staying the course, and cost. And so those are the big themes that you'll hear from us throughout this presentation. But what we're looking at here is what we call the build-up method. And so what we're trying to do is explain how we've achieved 20% returns in 5 out of the last 6 years. That's astounding. Those are astounding figures to see. And we certainly don't believe they're going to continue, but they could. And so let's retrace how we got here. So starting about 10 years ago in Q4 of 2014, there were certain elements in play that got us to where we are. And by the way, these were not in our forecasts. Okay, we got these wrong. And I'm sure most people out there got these wrong. So any forecast you see should be taken with a healthy dose of humility. We saw revenue growth explain about 39% of the distance between 10 years ago and where we are today in the marketplace. We saw profit margins enhance. Average S&P 500 profit margin going back 50 years is about 10 percentage points. Today we see it at about 12 and a half. So we've seen some increases in profit margins over the last decade, especially relative to history. Could that continue? Maybe. We'll see, but profit margins are really difficult to juice. Revenue is probably a little bit more malleable as a addition to market expansion. Dividends. So what dominates U.S. markets? What sector dominates U.S. markets? I'm sure many of you on this call can answer that, right? It's tech. And tech is not known for dividends, okay? So average dividends in the United States are about 1.8% a year in income generated from equities. Take that and contrast it to ex-US. So outside of the US borders, the average dividend is going to be about 2.8%, a whole percentage point higher than the US. Why is that? Again, because the US is dominated by tech. Outside the US, they're dominated by financials. That's really the major sector outside the US if you were to look at the global economy. And so dividends play a small role for US buildup. And then you look at valuation change. This is buying. This is folks like you entering the marketplace. This is the proliferation of default options in 401ks. This is the proliferation of low-cost investing. This is the democratization of platforms like Robinhood. And so what we've seen is, for by and large, not just the American investing public, but the world has really expressed confidence in the United States, and they're voting with their dollars. And so that valuation change of 30% is unprecedented, and it's really explaining a good chunk of this unexpected pop in the U.S. equity markets.
Well, thank you for that, Tom. That's a great explanation. Yeah, valuations have increased, versus history, but there's a lot of arguments, for why that's happened, which includes this sort of relentless bid theory that there's just more and more money pouring into things like the S&P 500 by virtue of retirement accounts and, democratization of, access to investing tools. So, thinking about the S&P, going a little bit deeper, you guys have all heard of, the Mag 7, right? And, we're looking at the top 10 stocks, not the Mag 7 here, but concentration has, just gone through the roof. So almost 40% of the S&P 500 is now those top, 10 stocks. And they are, not cheap, at 29.2 times earnings. The long-term average is about 20. The remaining stocks, the other, 490 are at about 18.9. So a little bit over the average, but not to the extent that the top 10 are. If we look, a little bit, deeper, the average stock, this is the S&P equal weight, right? So not, with 40% of the S&P concentrated in 10 names, but, equally weighted. The PE ratio is at about 16.39. So not everything is super expensive, and there may be some justification for the multiples that people are paying for those top 10 stocks. But this rally that we just had, two years of 20 plus returns, it has stretched valuation. So Brad, I'm interested to hear your thoughts. As you look across the landscape of different asset classes and investment themes and styles, where do you see prices being a little bit rich? Where do you see some opportunity?
Yeah, you bet. And great to be with you, and certainly with Tom as well. So this is how we think of things, and I just want to add a comment on some of Tom's prepared remarks as well, thinking about those margins. Let's be fair, right? Margins have been the compass point, certainly in this post-COVID world, right? So 2014 and beyond. 2014 to 2020 was actually an interesting period where rates were still relatively low. Margins weren't exceptionally healthy outside of the cost of capital advantage. You had a pretty challenging time for fundamentals, quite frankly, pre-COVID. COVID was a blip, thank goodness, and we know why. But post-COVID, 2020, really up until today, the fundamentals of really the S&P 500 have been exceptional. And a lot of it has been predicated on those top 10 names, right? To be sure, right? Thinking about the innovation trends that we're seeing in technology and communication services, and the strong US-based consumer, which I would argue very humbly has never been as strong, maybe outside of the post-World War II environment where you had a baby boomer environment and really the sprawl to suburbia. But this is something that we should be very cognizant of that this economy has been supported by strong fundamentals, right, of labor and consumerism, and as I mentioned, consumers that continue to spend with these innovation trends. Now, with that being said, uh, we have to be thinking like investors, right? I always like to say that. I've been at Fidelity a while, Tom's been at Vanguard a while. We've been doing the same, right, for a long time. And as strategists, we try to we try to be very intelligent about the pathway forward. But if I take that hat off for a moment and I throw on my investor cap, I have to be aware that that large cap growth box, right, the technology sector, is punching above its weight. And that might be okay because the earnings, right, should support that going forward. But anytime you have some uncertainty in the marketplace, it's typically the most expensive names that are going to feel the heat the most. And we've seen that, right? The NASDAQ's had some challenges here so far this year. Technology is not leading the way. So what do we like, right? Well, first and foremost, we still like the fundamentals of tech, but you probably have enough of it, right? Just given how well they've done. And if you haven't rebalanced appropriately, right, you're probably overweight there. This might be an ideal time to broaden your horizons, right? To think about diversifying across the equity landscape. So I'll give you a couple examples. Financials, right? One example, the financial sector, as you probably know, it's got a lot of these big money center banks like JP Morgan, right? Bank of America, but it also has plenty of regional banks and smaller banks. To us, financials look very, very constructive in terms of their pathway forward. Loan growth has been a bit anemic. Loan growth usually drives earnings. We expect loan growth to tick up here this year as households and small businesses are looking to actually, seek out new debt. We think that's really important. And again, a lot of people think it might be a recession this year. I quite frankly don't think that we'll have a recession this year. In fact, I don't believe we will. So I still like the cyclicality of financials. So I would say that's one area that people haven't looked towards that they probably should. The other component would be small cap companies. Small cap companies haven't done all that well in the last 4+ years. It's been large cap or bust. To us, small cap companies tend to do well when you have an economy that's improving, when you have the potential for deregulation and additional merger and acquisition activity, i.e., some of those smaller cap companies could be acquired by some of these larger cap companies, right, for immediate and accreted growth. Now, that hasn't happened yet. Why? Well, because interest rates seem to be stuck, right? They're not going down any further. At least that's the expectation. And you have this uncertainty of what's happening out of the Trump administration, which is causing risk, all things held equal, to wobble a bit. And small cap companies would certainly be exemplary of risk. But if you can stay the course, if you can see through, some of this noise, some of this headline risk, I think you'd be very handsomely rewarded by looking at financials domestically as well as small caps domestically. I think we're going to talk more about international. I know Tom has some thoughts there, but that would be my domestic idea, would be to think about some of these other equities outside of just technology.
Yeah, those are great insights. And we've got some slides on international that'll come up here soon. So thank you for that, Brad. Appreciate that.
Sam, can I jump in real quick?
Yeah, go for it, Tom.
Yeah, Brad really put his finger on the lifeblood of the American economy, which is loan volume. And he mentioned that loans have been anemic. I'd imagine most folks on this call probably have more in common than they do different, one of which is carrying a mortgage, right? We're at a place now coming through this ultra low mortgage rate environment through COVID, where we've got about 55% of home buyers that are still servicing mortgages under 4%. That's pretty wild, when you compare it to historical trends. And those folks are not going anywhere, right? Like they're not going to refinance their mortgage up to a 7% rate. And so if, the American consumer is really healthy, and I agree with Brad, it's a really interesting time to look at this almost dichotomy between policy uncertainty, global concerns about inflation and employment, and then our own employment scenario. It's really interesting. The American consumer, save maybe the news coming out this morning that we're seeing some weakness in consumer sentiment. They're in a really great place. They've got low service, percentage on their mortgages. They're making more than they have in a long time because wage inflation has really been healthy, and productivity growth has been healthy as well. So it's an interesting. You'll find this throughout the call for all the listeners out there, and Brad and I share the same sentiment. There's no such thing as a one-handed economist. we're always going to be like, well, on one hand there's this, and on the other hand it's this. So you're going to get a lot of that from us today, but it is a really interesting environment. Again, where we saw these massive refinances through the COVID crisis. I myself refinanced and down below 4% as well. It's going to take a lot of downward pressure on short rates and mortgage rates for the housing market to really start to turn a little bit.
Yeah, I agree with you, Tom. I think it's, the fundamentals, of the consumer, and then also the fundamentals of these companies. I mean, they refinanced a ton of their debt at super low rates also. That rate lock situation makes a big difference, and so the fundamentals are there, and these pullbacks, while the noise is occurring, should be looked at optimistically and opportunistically. So let's keep moving here. So where are we now, right? A healthy bull market needs to climb a wall of worries, right? We want to see some setbacks when everybody's in the pool and your barber's telling you about their Robinhood app, right? And people are just exuberant. That's not exactly a healthy bull market. A wall of worries is necessary. So what are the big ones, right? Of course, geopolitical, risks. Everybody knows those, right? The Fed policy direction. Are we going to get more cuts? Are they done? Where is that neutral rate? Will we see this growth renaissance in 2025 or start to enter a sort of stagflationary environment? The tariffs, of course, are a huge issue, and we're hearing more and more about it every day. And then the sort of debt hawks, that are concerned about our deficits, and then will that bill come due, right? And it's probably a longer term issue, not a 2025 issue, but it's an issue nonetheless. And then we've got some wild cards too, right? Which could rates rise from here? Like if we see inflation pick up, do we see rates go up, not stay where they are or go down? Productivity and profit margins, labor productivity and profit margins, like Tom alluded to earlier. That's something that we're paying a close eye on. And then reinversion of the yield curve and potentially recession is another sort of outlier wild card that we're keeping a close eye on. But the real focus as we're trying to find the signal through the noise here is economic growth, employment, corporate earnings, interest rates, and credit spreads. We think those are sort of the main things to keep an eye on as you're looking at your sort of dashboard and dials to say, where are we, how are we doing, and what's coming down the road. So let's get into some of these. Where are we now? Issues. What you see here is the U.S. Economic Policy Uncertainty Index. Go figure, it spiked, here in January. It's very high, and this is a good reason for it. We're looking at tariffs going back to the 1930s. This is where we've been and sort of the path of globalization, and this is where we are proposed to head, right? So much higher than before. Simply put, how will tariff policy weigh on growth and drag on inflation? This is Vanguard's base case plus Mexico and Canada, and then the max case. The slide is a little bit busy, but just to kind of boil it down, and then Tom will ask you to speak more about productivity and inflation, everything else. This base case is sort of 1.8 to 2.3 on GDP growth and 2.3 to 2.8 on inflation. We just got the new print in, which I think was year over year 2.8 this morning. If we have 25% tariffs on Mexico and Canada, 10% on energy goods, that's going to come down from 1.823 to 1.621, so about a 20 basis point reduction in GDP, and then a equivalent increase in inflation, 2.5 to 3. And then the max case, 60% tariff on China, 10% on the rest of the world. This is a sort of more dramatic shift, right? This is a 60 basis point change to that second case, but it's an 80 basis point change to the original case. 1 to 1.5% GDP growth, which is still positive. GDP's growing, and then inflation at 2.9 to 3.4. So, Tom, thoughts, feelings, on this slide and productivity and some of the things we were talking about before we started.
Yeah, so before we get into this, let me just say to this audience and empathize, acknowledging that Sam and I'd imagine many of you are located in the DMV area, and so may be affected by the current administration more than other parts of the country. And so just empathizing with that uncertainty. You probably feel the uncertainty about this specific political regime more than the rest of the world does. We're all feeling the uncertainty, but those of you who work for government are feeling more. I'll just take this moment to encourage you to lean on Sam and his team. I know they're doing a lot of analyses for clients on what potential future fiscal solvency looks like. And it's been, from what I've heard, a real help to a lot of clients out there who do work in the government sector. So I didn't want to miss an opportunity to empathize with those folks. Whether you hate Trump or love him, you're trying to figure him out right now. We're all trying to figure out what's going to happen next. What we know about tariffs and their effect on the economy is that about a 1 percentage point increase in the United States' effective tariff rate will result in about 10 basis points. And just as a reminder, a basis point is 1/100th of a percent. Okay, so 0.01% equals 1 basis point. And so a 1% increase in the U.S. effective tariff rate is going to result in about 10 basis points decrease in GDP for the year, and about 8 basis point increase in inflation. And so, to save you all the busy, scenarios on the right-hand side of the slide here, that's our heuristic that we're going by. Look at the slide on the left. I mean, this to me is a signal that since the turn of the last century, since the turn of the 1900s, we've seen globalization win. Globalization has been an incredible driving force in breaking down frictions, in creating deflation, healthy deflation for goods and services across the globe, in creating cultural linkages. I mean, there's just a long list of benefits of globalization. There's a shorter but very potent list of disadvantages of globalization. And I think we're seeing the pendulum swing back. How far back does the pendulum swing? We don't know. Does that proposed effective tariff rate that Sam showed in his last slide, is that realistic, or is that a bargaining chip? We've learned that the Trump administration likes to, carry a big sword, but maybe not use it as much. And so we're hoping that that's the circumstance here. Although we saw some more tariffs announced for China earlier this week, another 10% on our Chinese relationship. So what happens in tariff world is going to be inflationary. It's going to affect GDP. We don't know the extent to which these tariffs are actually going to come to fruition with our biggest trading partners, Mexico, Canada, China. It could be a lot of verbiage that's meant to create a better economic situation for the United States in the Trump administration's eyes, or it could all be very real, in which case that max case will play out and we could see some real headwinds to GDP. For you as investors, what we'd advocate doing is staying the course, staying diversified. Historically, we've seen the first year of almost every single president in the United States history, the first year be a positive year for the equity markets, despite the uncertainty of a new policy. That said, the equity markets hate uncertainty, and we're seeing a lot of that right now.
Right.
And
Go
Sam,
ahead.
can I just add something?
Please.
So, undoubtedly, I mean, I love these type of charts, right, Tom? Because they go back a century, and boy, there's a lot of information in a really simple chart. And I would agree. I mean, there are so many explicit and implicit benefits of globalization, right? And it's that comparative advantage, right, that certain economies have because of their raw materials or their labor know-how or their technology. That they can do better, and we would import from them, and we'd export maybe our technology to them. It's just something that makes sense. But what I would say, because we don't know, right, to what degree this administration is really going to be steadfast. And to your point, Sam, is it a negotiation tactic? I personally believe it is, right? Or is this more of an ideology where this administration is going to fall on the sword, regardless of what it takes to go ahead and change the global world order? Because we don't know that, right? And this is more of a conversation for maybe something like a libation in our hands, right? Post hours. The way I think of it is this: if we're going to see a challenge to trade, that's probably going to be inflationary, right? Even if it's the base case, right? This goldish color, that slightly higher inflation is going to be really an expense, right, to consumerism. And that could be a challenge for margins. And I know, Tom, we were talking about this in our prep session. This idea of productivity is getting thrown around a lot. But to me, productivity is nothing more than efficiency gains, right? It's doing more with less. It's allowing a corporation to keep their margins healthy, right, not sick. And it's a way to offset, right, some of this higher inflation or some of this, lack of growth. And good news for all of us is I believe we're in a golden age where you could see more productivity like we saw in the 1990s, early 2000s because of innovation. Maybe it's generative AI, right? As we move into a second phase there where volumes increase and barriers to entry decrease. That's just one simple example. But it's not all bad, is what I like to say. Fidelity always says that we need to deal with this stuff multilaterally versus unilaterally. Like right now, the whole world, even if you voted for this administration, you're thinking, wow, it all seems pretty negative, right? At least this noise around tariffs. But there's a lot of other agenda items that this administration wants to bring forth to go ahead and boost economic growth, like fiscal policy, deregulation, M&A. But we're just not focused in on that because there's too much noise on the headlines today, and a lot of it's negative.
Yeah, absolutely. That's a great point, Brad. And I think, with the sort of theme of, tariffs and reshoring, there's a, sort of tremendous amount of CapEx and R&D spending that's, coming down the pike. And if that's happening, within the country, of course, that could have some spillover effect, and be a positive as well. So, speaking of, sort of the broad growth of the country, we're looking at GDP here. The one part of the slide I wanted to focus on is consumption, right? So this is, almost 70% of our GDP is consumption. That's us, going out and buying stuff. So, we talk about consumer, finances, right? The sort of health of the U.S. consumer. The U.S. consumer has never been wealthier. After, everything that we've seen post-pandemic, the consumer is strong. We're starting to see debt ratios clip up a little bit, but nothing like we saw in 2008 and 2009, just kind of getting back to a more normal level that we saw before the pandemic. We are starting to see, delinquencies increase, right? So on auto loans and credit cards, it's still not the case on mortgages and student loans, although student loans will probably start ticking up because of legislation here and the sort of repeal of the, Biden era income-based repayment plans. But it's not, skyrocketing necessarily. And so the U.S. consumer is strong, and the Fed hikes, the Federal Reserve interest rate hikes, they have not slowed down the U.S. consumer. I mean, you can see the contribution to GDP has been picking up. We got some new data this morning that looks like the consumer slowed down a little bit in December, in January. However, that's also, related to seasonality and some other issues. So it's, only one data point, nothing, I think, at this point to worry about. But the consumer is strong. Now, what would get in the way of that consumer, right? The consumer is strong until they don't have a job, right? That is when people really change their patterns, right? Consumption patterns. If we look out, currently, job openings it fell, down from March of 2022, but it's actually picking back up. It's moving in the right direction. Quits are way down, and layoffs are ticking up, right? And that's sort of for, somewhat having to do with the government, although that hasn't really played into the big picture at this point. I think it's 200,000 jobs need to be lost to move the unemployment rate by 10 basis points. And so, ultimately, it's, we haven't seen a huge move yet. If we look a little bit more narrowly, this is initial jobless claims in Washington, D.C. And so we're looking at, it's ticking up slightly here, right? It's not where it was in, end of 22, early 23. It's certainly not where it was, around the COVID pandemic, but it's, directionally moving. If we zoom out a little bit further for Maryland, Virginia, and DC, you can see that it's less pronounced, right? We haven't really seen the impact at this point, but the federal government, employs a lot of people, especially in this region, but across the whole country as well. That said, the workforce, isn't sizable enough to necessarily move the dial across the country. Regionally, we're all very concerned, right, about our own, local economy, and I think for good reason. But if you zoom out a bit, it's not as large of an impact. What you're seeing here is the stock price of staffing firms, or the S&P 500 Human Resources and Employment Services, versus the JOLTS job openings report, and you can see they're kind of diverting here. What this would tell you is that the smart money, if you will, or people voting with their dollars, are buying these human resources and employment services firms, right? Which is a leading indicator that jobs should be rebounding, and more jobs should be getting created. And so big picture, I think the labor market, despite what's happening here at home, in the DMV, it is quite strong, and the sort of predictive indicator looks strong as well. So let's move on to inflation. Uh, this is the, where we've been and sort of where we are. Headline and core, popped up in the pandemic for obvious reasons. We're back now down, below the long-term average, but still not yet at the level that the Fed wants to see, which is 2% on the core PCE. If we look at some of the contributors to inflation, this is where we were, in the pandemic. Of course, energy, spiked, right? That's the green bar. Purple bar is food at home. Core goods is the orange one. Dining, recreation, and services is this sort of light blue. Auto insurance is the red, and then shelter is the dark blue. And so, the contributors to inflation have been coming down pretty strongly. It's shelter, which we know, operates on a lag that's been really, really sticky. But we're starting to see, core goods and energy detract from, inflationary pressure. They've been, disinflationary in the past couple of months. Auto insurance, again, has contributed, sort of an outsized amount than it should. And we're probably all feeling that to some degree. And then dining is starting to come down as well. So, things are moving in the right direction. Of course, like we said before, tariffs can make a difference, to that. So moving on to the Fed policy, right? So the reason, rates rose as much as they did is because of inflation. And now we're sort of on the back end of that. What you see is in the dark blue, this is the Federal Open Market Committee, their expectations of where rates will go between now and 2026 and then over the long run. And then you see the market's expectation, right? The market is pricing in, or the bond market, rates sort of staying flat around this, sort of 4% range. I'm interested, Brad or Tom, if you guys have any, insight into why the market and the Federal Reserve, have such differences in opinion about the direction of interest rates.
Tom,
Fred, do
I'll
you
follow
mind if I
your
go
lead.
back quickly to something that you and Sam, I'm sorry, Sam, do you mind if I go back quickly to something you and Brad were talking about with regards to
Mhm.
productivity? Yeah, so productivity is one of those things where it's similar to like the neutral rate, and I think this ties into this conversation about where rates are going. So productivity is the quantity of output for one unit of labor, right? The quantity of output for one unit of labor. Brad hit on this earlier. What's interesting about productivity growth is A, it's really hard to measure, and so it's a lot like tracking Bigfoot. But B, the other really interesting thing about it is it actually, productivity eats inflation for breakfast. And so if you think about a visual, if anyone has a fish tank at home, okay, inflation is like the algae that grows on the outside of your fish tank, right? Like on the glass perimeter. And it's a result of good things. It's a result of growth, right? Like if you have a lot of good sunlight happening in the fish tank and the environment is sound enough, you're going to have algae grow. It's typically a sign of a healthy environment, but you don't want it to grow out of control, right? Similar with inflation. Now, enter the beloved sucker fish, right? If you have a fish tank, you probably have a sucker fish, right? It's these guys that kind of cling to the side of the fish tank and they eat all the algae. And it's great. They clean the tank for you, right? Productivity is like the sucker fish. Algae is like the inflation. And so if we can maintain a higher level of productivity as economy, we can tolerate a higher level of inflation. And when I say higher level inflation, what I'm really talking about is wage inflation, because that's healthy. That results in more spending for the American consumer, more confidence for the American consumer, which is a great thing for our local economy. So productivity we love. And to Brad's point earlier, we see some of that playing out in the Gen AI story. We saw productivity kind of trail back during COVID because companies couldn't spend on technology. They were sort of on life support. And now we're seeing, $250 billion being deployed in CapEx to some of these Mag 7 companies. And so, can we keep productivity high to potentially eat the algae of inflation in the fish tank? With regards to the neutral rate, and what we're looking at here is the Fed's best guess at where the neutral rate is. You see a diversion between the marketplace and the Fed's plan. Two really important things to note. One, these Fed readings are usually on a lag, whereas the market's real time, right? These are based on surveys that occur across all of the open market commissioners and Fed governors across the country. And so if you were to take this snapshot in real time like the market, it might look a little closer together. I've got a few more points, but I'd love to defer to Brad to see what his thoughts are.
Yeah, and thanks a lot, Tom. And I would piggyback on productivity. So you look at this illustration, and Sam, if you want to put your cursor over, it's that in the table, change in real GDP, the first row, all the way to the right. So the very Fed themselves, guess who doesn't believe in productivity? It's the Fed, right? Or at least they're not forecasting it accurately, because they're showing a long run real GDP at 1.8. Now, ladies and gentlemen, remember, real GDP is quite simply the byproduct of a sum of two variables. One is population growth, which is a nice way of saying labor force growth, and the other one is productivity growth. And what the Fed is saying to us, right, in just their forecast, is that they believe this is about 50-50. Population growth for the US at zero point 0.9, productivity growth at zero point 0.9. Well, no offense, but zero point 0.9 is pretty anemic. It's basically what we've had the last 15 years. So I get why they're coming from this. But pre-global financial crisis from like 1994 to 2008, you had productivity growth that was 2.5 to 3%. Right. And of course, that was the golden age of computing, right? I guess golden age 2.0. So this is how I see it, right? I look at this and I say, the Fed's not the end all be all. There's even banter and debate within the FOMC, the Federal Open Market Committee, and the Board of Governors as to what the neutral rate of interest should be and how low they should go. In other words, back when the Fed was at 5.5% in September, they thought they were restrictive. But I have to tell you, I get to travel the entire country. And anecdotally, I kept saying to myself, well, where's the restriction? Right? The amount of economic activity was begging to differ with a restriction on 5.5%. So to me, that didn't even make much sense. And a lot of the economic data would also argue with this restriction mentality. And we know the Fed didn't want to stimulate when they cut. They recalibrated, and now here they are at 4.5. Our team believes the Fed is done for 2025. Not to say they're done with their cutting cycle, but this pause that they're employing is going to be a lot longer than I think people can appreciate or realize, especially when they're very dot plot, if you will, these blue and purple dot are showing a much lower rate of interest. And one last thought, Tom mentioned something called the neutral rate of interest. The neutral rate of interest, otherwise known as R star, it's pretty academic, right? We don't talk about it too much, and certainly it's not going to be in any Wall Street Journal publication, I don't believe, and it's certainly not going to be in the nightly news. But the neutral rate of interest is what the Fed believes should be their neutral policy rate that's neither accommodative nor restrictive. And I can tell you that rate has been stuck in the mud since the global financial crisis. And remember, the Fed funds rate was 5.5% in 2008 before it was zero. And I understand when rates are zero, the neutral rate should be lower, right? Makes sense. But we're not at zero. And we're nowhere close to it. And I suspect unless something really exogenous happens that nobody's forecasting, like a black swan event, like a COVID event, I suspect we're going to be higher for longer. And I also suspect the Fed's not nearly as restrictive as they think. So, Sam, I think the big question here is how restrictive are they? And if they're not all that restrictive, the Fed doesn't have to cut. And remember, the Fed has two mandates. Their two mandates are labor and inflation. Inflation is sticky enough and potentially going higher with the uncertainty of tariffs. Well, the Fed doesn't want to cut in that environment. If anything, they might have to just pivot and hike. So let's just cool it off a bit. And employment seems to be fine. So the Fed doesn't really have a need to cut. So the Fed's pretty much on the sidelines here for the foreseeable future. And I think this is just a way of reconciling that.
Yeah, I agree with you. I think the market is right on this one. Higher interest rates are a byproduct of growth, right? I mean, it's only the suckerfish and the algae. It's a great example. If we've got higher rates, it's there for a reason, and it's because we're growing, right? So, and a great point on productivity and what the expectations are from the Fed versus what I think the street is really seeing in terms of directionally where we should be going. So just briefly, these are the markets going back in time around a Fed cutting cycle. We're very early into this Fed cutting cycle. It may be the end of it, as Brad mentioned. We'll have to see, but the markets typically perform pretty well going forward. And so just briefly kind of summing it up, where are we on, all these different sort of, fundamentals, valuations, and technicals? Economic trends are, neutral to positive. We're feeling good about earnings trends, pretty good about Fed policy. fairly neutral on interest rates and real rates, and M&A, and IPO activity. We'll have to start to see some, and then that might turn positive, but fairly neutral today. Credit spreads were positive on also. In terms of valuations, yeah, ostensibly things look a little bit expensive, but for by and large, it's justified, right, by the fundamentals. So, we're neutral on those. And then for the technicals, for the most part, with the exception of sentiment, we're either neutral or trending positive. So, I want to get into where we're going, and just briefly, for everybody in the audience, there is a Q&A feature where you can submit your questions, and we're going to try to save some time at the end to answer those. So, if you want to submit questions, by all means, send them in. You may need to hit the little more button that has the three dots to get to the Q&A, unless it shows up right on the little panel that has all the other, sort of components to the Zoom room. So let's get into where we're headed, right? So I don't want to spend a lot of time here. Tom, this is one of your slides. I'll just sum it up. But the near-term risk in the U.S. is that valuations are stretched, right? But not everywhere, right? Just in subsets of different sectors like technology and communications. If we look out across the sort of the developed world, international equities are very attractively priced. We also expect the dollar to be a tailwind over the next decade. Emerging markets, a little more basket casey, right? And that really has to do with China being the largest, contributor to emerging markets, by weight. Although there are pockets of, EM that do look compelling. And so it shouldn't be out of your allocation entirely. Let's talk a little bit more about the earnings and CapEx and sort of directionally, what's happening, right? So, if we look at performance, right, Mag 7's right here, just up and to the right? You got the S&P 500 here in the middle, and then if you take the S&P and take out the Mag 7, this is where we'd be, right? So really significant difference. One of the main reasons for that is if you look back in time, the market is a predicting tool, right? It's a forward-looking tool. And so we saw earnings growth pretty much outside of the Mag 7, going negative, right? And waning, where their earnings growth was rising pretty consistently. Well, if we look forward into the future, right, if you look at this green line, it's still very high. Those earnings look really, really strong, but it's trending down, right? That's the expectation, function of the market, the forward-looking discounting, function of the market. If you look at the rest of the S&P, the earnings growth isn't as high, but it's trending up, right? It's trending in the right direction, and the market looks forward. Of course, margins in the S&P, 500, ex Mag 7, they're also trending in the right direction. So profitability increasing, whereas it looks like in the Mag 7, it's starting to stall out a little bit. And one of the big reasons for that is where they're spending their money, right? It's CapEx and research and development. So we talked about this a little bit before, but this is all meant to promote productivity in the economy, right? I mean, the generative AI and everything else that comes along with it, which we can barely scratch the surface on, right? They are spending a boatload of money. I think Tom said earlier, $250 billion, right? This is meant to absolutely create more, productivity and efficiency. However, it should eat into those profit margins and earnings per share in the Mag 7 to some degree because they are spending a lot of money. It's an investment in the future, right? So you shouldn't discount that as a bad thing necessarily, right? It should show up in future earnings, but at least in the near term, we should see earnings still high, but trending in the other direction. Whereas the rest of the S&P 500, that won't be the case, or it's likely that won't be the case. At least the earnings projections say that. Speaking of AI and its impact, this is another Vanguard slide here. There's sort of three cases that we're looking at in terms of how it impacts productivity. But scenario one, AI fails, right? And we end up with about 1% growth in GDP, right? So the productivity doesn't pull through. Tom and the gang at Vanguard have given a 30 to 40% probability to that. The status quo is that our economic past resembles our economic future. Pretty low likelihood on this one, right? But about 2% GDP. And then sort of the highest case scenario here is AI is transformational, right? And productivity surges as a result. And we'd be looking at about 3.1. So to Brad's point earlier, if demographics or the pop workforce essentially is 90 basis points of that 1.8 that the Fed had, right? This is the rest of it, right? It's coming from AI and productivity. So Tom, I don't know if you have anything you want to add to this slide, but I thought I'd offer the opportunity.
it's such a hot space. I'll be brief, but the whole AI revolution is likened to electricity from our perspective. Its adoption is going to be slow, but its use case is going to be pervasive in about 10 years. And the way this technology typically applies, whether it's technology like electricity or the internet or vehicles, gas-powered combustion engine vehicles, is in the short run, its impact is usually overestimated, and in the long run, its impact is usually underestimated. We think this is no different. AI is not going to take your job, but the guy who knows how to use AI is going to take your job.
Yeah, we'll all be cyborgs here soon.
Yeah.
Brad, I don't know if you have any thoughts on AI that you
The
want.
only thing, yeah, I mean, the only thing I'll say is, I agree. To me, AI is gravy, right? Everyone gets wrapped up in some of the hot stocks that have obviously been at the forefront, right? And we know those names over the past couple of years. I mean, that's been, if you're in those names, it's been great. I mean, who doesn't like to make money? But what I would say is, to us, it's more about innovation, robotics, right? Automation generally. Uh, the world's just not making enough babies. I mean, that's it, right? And that's unfortunate. Fertility rates are coming way down, especially in the emerging economies, right? They used to be that's where we saw a lot of that human capital growth. That's probably behind us, right? And if you agree with that, remember that GDP equation, population growth is one significant variable. So if that continues to trend lower ever so slowly, you're going to need to see productivity. And I didn't say this earlier, but it's a pretty cool statistic. Productivity has an 88% correlation to earnings growth, right? And stock prices follow the earnings. These are like big, bold statements, right? So if this plays out to the right-hand side, and I like the fact that it has the greatest odds here, Tom, so I'm going to go with it. Yeah, if you get this 3% average GDP growth on real, never mind nominal, you throw another 2.5 to 3% inflation. Now you're close to 6% nominal GDP over the next decade. You better be in equities, right? And because it's going to be, you thought we had good growth over the past several years. It's going to be one of those areas. So that's why we're buying on these dips, right? With these headlines and all this noise. We're not married to the market, but we're certainly looking to marry the market, right? I mean, for long-term growth, this equity market is poised to continue to do well. But the fact that stocks are pricey increases the probability of a market pullback for anything more than a slight breeze, and that's exactly what we have. So
Right. Yeah, the fundamentals are there. The story is real. The pullbacks and the noise are opportunities. I appreciate that sentiment. Now, if we look outside of sort of the growth world, I mean, there are pockets of the markets that look very attractive. Value stocks look on a forward-looking basis. The return profile looks attractive based on the current sort of PE framework. You know, uh, a big part of value is financials, and Brad pointed to that earlier. If your portfolio has drifted into all growth, this would be an opportune time to do some rebalancing and thinking about parts of the market that just haven't performed nearly as well. A rising tide tends to lift all ships in a sort of secular bull market like the one we're in, and we would expect the valuations and PEs to begin to follow through to the value sector. I don't know if you guys have anything that any points you want to make on value.
would you like me to say? I could. So I would just say it's been unloved for all the right reasons, right? The fundamental growth has been very acute on the growth side, and we always think about value versus growth as value versus growth, but it really is a sector story, right? And the industries that make those sectors up and the companies. So I always think of growth as technology, communication services. So comm service would be like Google, right? Meta, tech, obviously Apple, right? NVIDIA, Microsoft. And then you have discretionary, which, pick all your specialty retailers. They've done really well here. And as I mentioned, they should participate in this market, but they're pricey. A lot of the money's flowed there. And if we're seeing some uncertainty, yet the economy still holds up, we use this word cyclicality. Sounds fancy, right? But what we want to do is we want to buy companies that have their top line revenue that has higher exposure to the health of the economy, to the vitality of the economy. And that is a base case of ours. The vitality is going to remain, alive and well, and you're going to want to own those areas in financials, right? Maybe industrials, maybe even some commodities. So, the fact that they're cheaper, that's not my number one reason to own it. The fact that they're cheaper, and I think I saw it somewhere on one of these slides, maybe it was international, I think we'll talk about it, but cheaper with the catalyst. That's what's key here. And the catalyst that it's presenting is the uncertainty, and large cap tech is, losing some of its luster. That's okay, right? You can go ahead and shift to value and probably get some of those gains. I mean, financials to me is the number one sector in 2025. I could be completely wrong on that, but that's where my mind is for this year.
I love it. Perfect. Um, so moving from value into the small caps, right? So, the macro variables have supported this underperformance. Tom, if you want to briefly just describe what's on this chart, these two lines, so I can, and then I'll get into the next one here. But what are we looking at here?
Yeah, sure. So the gray line represents Vanguard's forecasted range. We don't like to have a specific number forecast. We do it in a range, above and below the median expectation. And we've just consistently punched below that median expectation for small caps. Why is that? There's a couple of reasons we could probably point to. First and foremost, just the rise of this idea that the winner take all economy has prevailed. And so you think about the small cap premium, that existed for 20 or 30 years that Fama French wrote about in his research. That's getting real nerdy for all you nerds out there. You didn't have as much acquisition activity at the top. You didn't have as healthy private markets as you do today. And so it's possible that the small cap premium that once existed has been eroded away by the likes of Google and Meta and Microsoft buying their competitors before they can get competitive. Okay, so think about maybe the biggest small cap manager in the world is Google. Maybe it's Microsoft. Okay, or perhaps another scenario that could explain the underperformance of small caps. We've seen this flood of assets into private markets, private equity, which is an interesting space. We can talk about that if you want to. The fact of the matter is, it's a massive space that has garnered trillions of dollars in flows in the last just 5 to 10 years, and those dollars are looking for deals. And so maybe a small cap company or a private company that would have IPO'd doesn't IPO now because they've got capital that's being funded from the private side of the business. And so maybe that population of small cap performers that would have been hitting home runs in the portfolio and creating that premium in the past has been eroded away because of those two forces. The third one that's worth mentioning quickly is regulation. And regulation is always going to hurt small caps more than it does large caps, just because they don't have as much room in the balance sheet for overhead. And so perhaps as we see regulation come back with this political regime, you could see small cap make a run. Certainly from a valuation standpoint, small cap is due for a run. But keep an eye on those persistent factors of private markets stealing your public small caps out of the public market. And then the larger cap Mag 7 type firms buying those small caps before they can get effectively competitive in the public market.
Yep. No, those are great points. Thank you, Tom. I think what we really want to see is if the expectations for earnings growth here in the small caps follow through. What you see here in the bottom right hand side is earnings expectations, for small caps, and they're through the roof, and multiples of mid cap and large cap. I think deregulation is a big part of that, and the expectations therein, and other policy reactions. But if we see earnings follow through, there could be a lot of potential there based on actual fundamentals, the earnings rising, and the current valuation that we see today. So we want to keep an eye on small caps. International, they are about as cheap as it can get. So, we're looking at the MSCI All Country World ex-US index and the S&P 500. Ex-US is trading, sort of at its 20-year average PE ratio with the S&P above its 20-year. And so the diversion between them is now, almost a 40% diversion, two standard deviation move, huge move. They are super duper cheap. And we think that, if the dollar is, maybe not at a a peak, certainly sort of close to it versus a basket of foreign currencies. As you know, the dollar declines versus other currencies, you get a tailwind on your total return after converting, from U.S. dollars to the foreign company, dollars. So, Tom and Brad, I'd be interested to hear your guys' points on international. Vanguard has a very strong point in terms of outperforming U.S. equities, looking forward. But how do you guys feel about U.S. versus international outperformance?
Yep, thanks, Tom. So, so one thing we would say is, U.S. has a premium valuation because of the fundamentals, right? And I even think about it a bit more broadly, just to explain, looking back, and then I'll speak quickly about the forward. Looking back, remember Europe had the double, if you will, a double dip sovereign debt crisis, right? So kind of like the global financial crisis part two, 2 years, 3 years after, right? 2011. And then since that time, they had currency issues. They had an index methodology issue that I think Tom said it, like financials reign supreme in these international indices, European and Asian financials. One thing you will not find in those international indices, certainly on the developed market, is any technology. I mean, you'll see like 7% of the MSCI EFA is in tech, 32% of the S&P 500 is in tech, right? So it's very different. I mean, if this was a baseball team, it's like saying every third batter that comes up is technology, right? Or is your best slugger. But if you're an international baseball team, it'd be, well, they wouldn't even be up in the lineup, right? Because it'd be one out of every 12. So it's a very different environment here, right? You also could argue the Bank of Japan, arguably, right, the biggest central bank outside of the UCB, they went negative interest rates in 2016. They employed yield curve control. So their biggest banks didn't benefit from any of that. So there was a lot of experimentation overseas. And I think that's a real challenge. Maybe one last one. If you think about the demographics, we talked about that, right? GDP growth trends overseas, historically and going forward, they don't look all that great, right? Productivity is most likely going to be a domestic story. You have socialism. Socialism isn't great, right, for profit maximization. There's not much risk taking overseas in Europe. Japan has some of the worst demographics on the planet Earth, meaning they have no immigration. They're getting older and older. I only bring this up because there's a reason why they're cheap. Now, let me pivot to the future. I'm not so sure about the 4.2%. I think some of that's just the current valuation dichotomy spread. But the way I look at it is we're not investing in countries here, right? Nobody's trying to sell you the German GDP fund, right? But we do invest in companies. And we do believe there are a number of world-class franchises as an active manager that just happen to make their HQ outside the US. And we're buyers, right? We're buyers. And what we're seeing so far this year, I mean, my goodness, Europe is trouncing the US, and even international is beating US handedly. I don't know how protracted that is, but what I would never want to do is be naked international. And I got to tell you, I meet with so many investors who say, well, why would I buy it? It's done nothing for me. Well, you're buying the wrong strategies, right? You have to be active there, right? Is how I see it, because you have to really be discreet on buying the right companies. And you can make a lot of money overseas, especially with this catalyst. And the catalyst is just like the growth to value. It's just the fact that you're going to start to see a broadening of the overall equity market. And I suspect areas like Germany, areas like Japan, even though the countries are less than great, the companies that are there, there's certainly a strong handful of them that can make you money. So, yeah, I would say, act accordingly there.
I think that's a great feedback, Brad. I want to be respectful of your time and Tom's time. We're at the top of the hour. If you guys have hard stops and need to jump, by all means, feel free.
I do have a 1 o'clock. I apologize, Sam, but I appreciate you having me on, and it's great to be with my colleague Tom. I think it's great to have Fidelity and Vanguard together with you here. So that's great.
Well, I'll take this opportunity to thank you very much, Brad. We really appreciate it. And Tom, I don't know if you have to jump. I can take us home, certainly, but if you've got a one.
I can hang for another 5 minutes.
Okay, wonderful. All right, so I'm going to keep pushing. Do you have anything you want to say on the international side that Brad didn't cover?
I just think it's a really interesting point, and I want to highlight Brad's point. We're not suggesting overweighting international. Okay, like this is just hey, keep the position, maintain it. Diversification wins the day. Did you have an opportunity to earn more if you completely avoided international in the portfolio over the last decade? Yes. Okay, you did. but we don't know what's going to happen next. And valuations and some other economic factors point to international having the potential to outperform domestic over the next decade. So don't abandon the position is our rally cry.
Yeah. And don't necessarily, it's like you said, we're not buying countries, we're buying companies, right? So discerning selection will make an impact. Let's jump into fixed income here. What we're looking at right now is the current yield on Barclays Bloomberg U.S. Aggregate Total Return Index, and what it implies is a roughly 5% forward return on bonds right now, which, from a financial planner's perspective, if I can make an assumption around 5% on a, sort of lower volatility, lower correlation, component of the portfolio, that's huge, right? I mean, that's a really powerful tool from a planning perspective. So, fixed income had a, really rough time in recent years as interest rates rose, but it's positioned really well right now. And then, looking at if we see interest rates, stay flat versus if they, rise and fall, interest rates have an inverse relationship with bonds, we know, right? So as interest rates fall, bond prices rise. The longer the duration, the further out you go, the more an impact it has. But even if we look at, 10-year U.S. Treasury note, if interest rates do nothing, you're at 4.5%. If interest rates fall by 1%, your total return is 12.4. And so I think that, people need to be thinking about their fixed income allocation now. And a good reason for that is because portfolios have drifted. So if you started in 2019 at a 60-40 allocation, 40% bonds, 10% international, 25 growth, 25 value, today your 40% fixed income would be 26, right? So you'd be closer to a 75-25 allocation than your original 60-40. And so it represents an opportunity to, look at this U.S. growth sleeve, which has now become an outsized component of the portfolio at 37%, right? And reallocate into some of these other pockets that have not done as well, but that on a go-forward basis look very attractive. And then, of course, time is time beats all, right? We don't know the range of results of an investment performance over short periods of time, right? In any one year, you could be up 52, down 37 in stocks, right? And if you've got a near-term goal or a liquidity need, you probably shouldn't be in the stock market in the first place, right? It's just too unpredictable. But if we look out over 5, 10, and 20-year rolling periods, if you can stay invested, stay in the game, avoid bad investor behavior, you're typically rewarded, and rewarded handsomely. So, try to find the signal through the noise, stay invested. It's not about timing the market. It's about time in the market, right? So the sort of, base case from my back office, Mariner, for this year, real GDP between 2 and 2.5, federal funds neutral rate of around 3.75, which is about 50 basis points from here. 10-year Treasury yields, a little choppy, but sort of averaging out around 4.5. And then looking at S&P earnings growth of 10 to 12% this year and 12 to 15 in 2026. So that base case essentially says if we keep the current, PE ratio, valuations don't get stretched further, but they kind of stay where they are with, consensus estimate earnings of $310. We're looking at the S&P at 6,600. That's about a half, 50%, chance. Optimistic case is, closer to 7,000, disappointing case 6,000. And then the pessimistic case, which is a higher percentage chance than the disappointing case because it's based on the tariffs and inflation and, growth stalling, which I think, we've all said on this call, things look strong absent a sort of black swan event. We'd be at about 5,000 on the S&P. So I did have a couple of questions come in, and I can kind of fold these two together, right? So the question asker basically is saying that robots will be the next iPhones. We'll all have one, in our homes. How fast do we expect this to happen, and which companies will win the race? And then a sort of segue. Do we think that robots will offset the declining birth rates in maintaining productivity? So Tom, I'm not sure how much you've thought about the Jetsons style robot in the house. But it's certainly a very interesting thought. Anything you'd mention on that?
Yeah, Joe, I love these questions. I'm a big fan of 70s and 80s movies about the future. So whether it's Back to the Future or Total Recall with Arnold Schwarzenegger or Blade Runner with Harrison Ford, all those movies are really fascinating. But I think what broke the imaginations of the 80s producers is this idea of intangible robotics. So think about Alexa, think about Siri, some of these AI aspects of our lives that have been inserted and will continue to insert. In terms of hardware robots and robotics, we see a lot of replacements for medical procedures, self-driving cars, some of those things maybe taking on a potential life of their own. But at the end of the day, human beings don't trust robots. They just don't, whether it's raising their kids or performing a medical procedure or taking them from point A to point B. We're not ready for that as an American public yet. Will we be at some point? Maybe. But you've seen reports of a self-driving car is 97, 98% safer than a human driver. But the reports of the accidents are received very differently by the American public. I'll stop short of recommending stocks. I'm a Vanguard guy. We buy the index. So I don't know that I'm your best bet for that. Is there a future for robotics? Absolutely. The question is, what is the market pricing it at right now? And what does it have the potential to become? And I'm not sure that I can healthily answer that for you, but we do see application. We do see research coming, at a really fast pace that's suggesting that it's got further to run.
Yeah, the whole uncanny valley, humans and interacting with whether it's AI or robots, and there will certainly be early adopters. There's no doubt about it. But I think at scale, it's going to take some time. And it's one thing to be right about a theme. It's another thing to be right 10 years too early, and for your capital to suffer, during that window of time where it could have been allocated otherwise. So I think, I definitely agree with the question asker in terms of, this being a big theme in the future. I just don't know how soon I would expect it to really show up in our households and to probably show up in your portfolio as a contributor to, positive returns. So I think with that, we are a little bit over time. I don't see any other questions in the hopper. So I will take this opportunity to just, remind clients, focus on what you control. Try to tune out the noise. We're long-term investors. It's about time in the market, not time in the market. We'll be using all these themes for, rebalancing and reallocating. If you have any questions, of course, just contact me directly. The spring review cycle is coming up in about 2 weeks. I hope to see everybody between, March and May, and we're certainly going to have some portfolio discussions, about incorporating these themes. Tom, I want to thank you so much for your support, not just today, but in the past many years, and hopefully we can have you back at some point.
My pleasure, Sam. Anytime. Thank you for having me.
Okay, all right, and thank you, clients, for joining. We appreciate you deeply, deeply, deeply. Please feel free to reach out if there's anything that I can do for you. If you have any questions you want to take offline.
Have a good weekend.
You too, Tom.